Take the smartest people in the world of money. Give them the best educations, the fastest computers, teams of analysts, and billions of dollars to play with. Their entire job, the only thing they are paid to do, is to beat the stock market. Now put them up against a fund that does nothing. No genius, no research, no manager even trying. It just buys a tiny piece of every big company and sits there. Over the long run, the fund that does nothing wins. Not sometimes, almost every time. And there is a piece of math behind that. Quiet, simple, and almost impossible to argue with that guarantees it. Every year, a company called S&P keeps score. They take the actively managed funds, the ones run by professional stock pickers, and ask one simple question. Did you beat the plain index? Over a single year, most of them lose. In 2024, 65% of large U.S. stock funds failed to beat the S&P 500. In 2025, that climbed to 79%. But one bad year could be luck, so stretch it out. Over 15 years, 89.5% of them lost to the index, 9 out of 10. And here is the line that should stop you cold. Over that 15 years, across every single category they measured, there was not one where most of the managers beat their benchmark. Not one. Now your brain does the obvious thing. Fine, most lose, but some win. About 1 in 10 beats the market, so just pick one of them. Find a fund with a hot streak and ride it. So they tested that too. They took the very best funds, the top 25%, and simply followed them forward. Take the top performing funds from 2020. 4 years later, how many were still in the top quarter? 0. Not a single one. A hot streak, it turns out, tells you almost nothing about the next one. Last year's genius is next year's average. Which is exactly what you would expect if the winning was never really skill, but luck, wearing a very expensive suit. So why does this happen? Are the pros just bad? No. The answer isn't talent, it's arithmetic. And once you see it, you can't unsee it. Think about who owns the stock market. Every share is held by someone. Split them into two groups. One group buys the whole market and holds it, the passive investors. The other group is everyone trying to beat it, the active investors, trading against each other. Here is the trick. Together, both groups own the entire market. So together, they must earn exactly the market's return. No more, no less. The passive group, by definition, earns the market return. Which means the active group, as a whole, must also earn the market return. Before costs. But the active group doesn't invest for free. They pay for research, for trading, for the manager's salary. So after costs, the average active dollar must earn less than the market. Always. Not on average in a bad year, but as a certainty in every market forever. This is Sharpe's Arithmetic, named for a Nobel Prize winner, and it is the whole game. The average person trying to beat the market is guaranteed, as a group, to lose to the person who didn't try by exactly what they paid to try. And that cost? It sounds like nothing. An index fund might charge you 0.03%. An active fund, 1%, often more. 1%. Who cares? Compounding cares. Remember what a tiny rate does over decades. Run an extra 1% a year against your portfolio for 30 years, and you don't lose 1%. You lose roughly a quarter of your final wealth, handed over, slice by slice, for the privilege of underperforming. You are not just paying for a worse result. You are paying, richly, to almost certainly do worse than doing nothing. If this all sounds too clean, it was tested with real money. In 2007, Warren Buffett bet $1 million that a single, boring index fund would beat a hand-picked basket of elite hedge funds over 10 years. 10 years later, the index fund had returned about 125%. A compound annual growth rate, or CAGR, of roughly 7% a year. And that is the number that actually matters. Not the flashy total, but the smoothed yearly rate it compounds. The experts, the best money could buy, managed closer to 2% a year. It wasn't close. So here is the uncomfortable, liberating truth. You do not beat the market by being smarter, or working harder, or finding the secret. In the aggregate, after costs, that is mathematically impossible. You win by refusing to play that game, by owning the whole market as cheaply as possible and then leaving it alone. Now, be honest about the other side. Some funds do beat the index, about 1 in 10 over the long run. But dig in, and even that shrinks. Some of those winners only pulled ahead by taking on bigger risks. And once you weigh the reward against the risk they took to get it, fewer still are truly ahead. And you almost certainly can't pick the real ones in advance anyway, because past winners don't stay winners. This is math and history, not advice. Your choices are your own. The market doesn't reward the one who tries the hardest. It quietly rewards the one who stops trying to outsmart it. The pros have known this arithmetic for 50 years. Now you do too.